Hello and welcome to Options in Plain English. Today we're going to be learning how to read a risk profile. This is going to become very important going forward because the positions that we're looking at are starting to become more complex. And once we start going into combinations of stock, calls, and puts, then it's important that you understand all the information that you can get from looking at a risk profile and how to interpret that information. So now we're going to start by looking at an example. Don't pay too much attention to the actual strategy itself. Just what we're going to do is we're just going to take a look at the profile, at this graph, and get and interpret all the information that's in there. To begin with, we start with the axis. So we have the P&L on the y-axis, and we have the underlying price on the x-axis. So this is representing all the different prices that the underlying can be having as you analyze a certain strategy. And on the y-axis, you have the P&L. So anything that's above the x-axis here on the y-axis is going to be profit, and anything that's below is going to be a loss. So this is standard procedure. This is pretty self-explanatory, but still worth mentioning just to make sure we're all on the same page. Next, we have the expiration and T+1 line. So we have here the probably the most important part of the profile is the expiration line. So this is what some traders call the hockey stick line. So this is the profit and loss at expiration, depending on where the underlying price ended up. Okay, so for example, in this case, you know that anything that's above is going to be a profit. So this is going to be profit right here. And then this turns to a loss in here. Okay, so in this case, what I'm plotting here is two lines, one for expiration, okay, the solid line, and then another one for what I call T+1. So this is a representation of any time after you put it on. Okay, so this is prior to expiration so that you can get a good idea of how the profit and loss line starts changing shape as time passes. So this dashed line is going to start getting closer and closer to the expiration line, and until at expiration it's going to merge with it. Okay, so one of the most important things in the profile is the expiration and T+1 line. So these are the lines. The trade lags. So all the different elements that you need to build the position are calls, puts, and underlying, so stock. So the way it works here is you have the different prices. So these would be price points. So later on, we're going to see that these are strikes, but the elements that made up the strategy are going to be either on top or on the bottom. So above or below the actual underlying price line. So anything that's above means that that element is being bought, and anything that's below means that that element is being sold or sold short. So in this case, for example, and we're not looking at the strategy, but just interpreting this information, what you would have is you would have a put here at this point, at this strike price. So you have a long put right here, and then long underlying or long stock here because it's above the line. And then at this strike price, you have a short call because it's a C for call in the little circle here, and it's below the line, meaning that it's being sold short. Okay, so this is how you interpret the different elements or the different legs that make up the actual position or the actual strategy. In this case, for example, long a put here, long underlying here, and short a call here. And remember, so these are right here. And remember, we're talking about strike prices. So again, this is the axis where we're looking at underlying prices. So these are prices, and these are the different strike prices that you need to build your position. So even though, as you can see here, there's no numbers because this is a general representation, you can see that their relative positioning matters a lot. So if I have, for example, here, and I'm talking about at the money and case, at the money is where the price is currently. So if you sell or if you buy a call or a put or underlying, obviously, at that price, that would be the at the money. That strike price would be the at the money. The K, the different strike prices, their relative positioning is important. So, for example, in this case, even though I don't know by what the distance is between ATM and KC, or ATM and KP, or KC and KP, I know that their relative positions are important. So I know that the strike for the put is below the at the money, and that the strike for the call is above or higher than the at the money. So that's important. And in this case, once you identify the strike prices, you can refer to them in a general manner so that you can apply this strategy to any underlying that you have and at any price that you have. Structure. So once you have identified that you have a need for this particular legs at this particular prices, now you can have the structure of the strategy. In this case, for example, and again, don't pay too much attention to the strategy, but this is just to interpret what we have here. In this case, we'd be talking about long 100 shares of the underlying at the money, which is right here, and it's long because it's above the line. Short one out of the money call at strike price KC, which is this strike price. So it's short because it's below the line, and it's call because it has a C right here. And then long one out of the money put at strike price KP, which is right here. Okay, so this is the structure. These are all the different legs or all the different components that you need to put on in order to initiate your position. And again, this is sometimes or most times the strategies that are well known are going to be preloaded in your platform, so that if you want to, for example, buy a debit spread, for example, or sell a credit spread, or do any of those predefined strategies, then they're going to be there, and you're not going to be having to go and buy or sell the individual legs, but as they're going to be part of a whole when you put on those strategies. Next, we have max profit, self-explanatory. This is the maximum profit that you can get from this strategy, and we show it here on the actual line, on the actual graph, and we also show the formula for it. So, for example, in this case, what I'm saying here is, or what the risk profile is stating here, is that the max profit for this strategy is going to be equal to this strike price, KC, minus the at the money, which is where the underlying was bought, minus the cost of the put, which is going to be how much it costs to buy, and minus the cost of the call, which is what you got when you sold the call. So it's important to notice here that when we talk about at the monies and case, we're talking about strike prices, and when we reference P's or C's or U's, it means the actual prices or the premiums or cost of those options or of that underlying. So these are strike prices. These are how much it costs. So for example, if I buy a put for $2, then P is $2, which, because it covers 100 shares, it would be in a total of $200. But if we talk about a per contract, and most analysis focus on a per contract basis, so in this case would be calling P equal to a $2. The next element is max loss, something similar to max profit. You show it on the graph, and you also have the formula. So in this example, you also have the strike prices, and you have the value of the actual options. So in here you have the add the money, the original add the money minus the strike price for P, KP, plus the amount that you paid for the put, P, minus the amount that you got for the call, which is going to be C. So again, max loss also clearly represented and clearly shown on the actual risk profile on the graph. The break even, again, very important. This is the point where a profit turns into a loss as you go from price to price. Okay, and I'm showing it here, and I'm showing it on the graph, and I'm also showing it on with a formula. So the formula for the break even, for example, here would be the add the money, the original add the money, plus the cost of the put minus the cost of the call when the position was put on. So now you know how to calculate the break even for this particular position. And finally, the profit and loss areas, which is pretty visually easy to see, but still I'm going to mention it here. The anything that's in green is going to be a profitable area. As you can see, the break even is here, so anything above is going to be a profit, and anything below is going to be a loss. So profit in green and loss in red. Now we're going to move on to a different example, just because it has a different element that we didn't have before, and I want you to take a look at it. So in this particular strategy, again, don't pay attention to the strategy. It's called a Jade Lizard. We're going to be taking a look at it later, but just focus on the information that we have. The 10th element would be a condition. So sometimes when you have a certain risk profile, you have a certain condition that needs to be met before you put it on. Otherwise, for example, all of this area wouldn't be profitable. For example, here the condition is, in order not to have risk to the upside, the PS plus the C1 minus C2 has to be greater than or equal to the difference between K2 and K1. So this condition has to be met prior to putting it on, because otherwise, for example, in this particular case, if you don't have this condition, and if it's not true, then you're not going to have all of this area as a profitable area. So it's important to look at the conditions. Some positions have a condition, a precondition, so to speak, and some of them don't. For example, the one we just looked at didn't have any condition at all. But some of them, especially these ones that are a little bit more complex, have a certain condition. So it's important that you look at that before you put it on. So if we want to do like a summary of what we just learned, we can just quickly go through all these elements for this example, so we know that that you understood them. Axes, you know what they are: P&L and underlying price. Expiration and T+1 line. Expiration T+1. So this is what's going to happen at expiration, and T+1 is this. So at any time prior to expiration, you're going to have this P&L line, which is going to start here and is going to start approaching the expiration line until it finally merges with it. Trade legs, calls, puts, and underlying. In this case, for example, we have both puts and calls, but we don't have any stock. So now we know that we need to put on this position by selling this put, PS, at strike price, KS, selling this call, C1, at strike price, K1, and then buying this C2 call at strike price, K2. So those are the strike prices. Here's the at the money where the price is right now. So all it's saying here is that for this particular position, the short put has to be below the at the money, so at a price that's under where the price is right now, and the call should be at a price that's higher than where the price is right now, and C2 as well, even higher than at the money, and higher than K1 as well. So their relative positioning is important, even though it's not mentioning any number at all. The structure, you can read it right here. This in order for this position to be put on, you need a short one out of the money put at KS, short one out of the money call at K1, and long one out of the money call at K2. Okay, and this is the position. Once you put it on, you're gonna have this P&L at expiration if the condition is met. Max profit is this. This is the formula. What you pay, what you got for the put plus what you got for the call minus the what you paid for the call that you bought. So PS plus C1 minus C2. And also you can see it right here. Max loss would be this strike price, KS, minus the max profit, which was the initial credit. And the max loss is going to happen if the underlying goes to zero. So even though it's not, for example, this particular, and again, don't pay too much attention to the strategy, but just interpreting it doesn't matter that I don't know what this strategy is. I can read it and I can interpret it just by looking at it. So as you can see here, the loss is pretty much undefined or unlimited because it can go to zero. So even though it has a limit, because zero is a limit, it's a pretty substantial loss. So that's why I'm mentioning here that if the underlying goes to zero, you would have a max loss. The break even is clearly right here. This is the point where the profit turns into a loss or vice versa. The loss turns into a profit. And the formula is the break even, this point, is going to be calculated by having this strike price minus the max profit, which we already calculated here. And then the profit and loss areas. As you can see, one of the main advantages of this particular strategy, the Jade Lizard, is that it has a very wide profitable area. Even though the profit is not unlimited and it's limited and it's capped, still you have your prices here, and anything that ends up above this break-even point, you're gonna be making a profit, even if it's only 1 penny. At least you're not going to be losing money. So break-even is KS minus max profit. Anything that's below is going to be in red, is going to be a loss area, and anything that's in green, that's above the break-even, is going to be a profitable area. And finally, the condition. In order for us not to have risk to the upside, we need to make sure that this condition is met. And once we know that, then we can put it on. And now, once we put it on in real life, instead of having this symbols, now you're going to have the actual numbers, and you're going to be able to figure out whether your strategy meets your expectation for price movement, for volatility, and for time passing. So this is the way a risk profile is analyzed, and I hope this makes it clearer, because from now on the different risk profiles are going to start getting more complex, because we're going to start combining more calls and puts at different strike prices, and also sometimes even stock. So I hope that this is a little bit more understandable, how to read a risk profile and how to get all the information that's in there. And that once you take this information, you're going to be able to take any risk profile without even knowing the strategy, and you're going to be able to apply it in your own trading. Thank you very much for your attention, and goodbye.